Welcome to everybody. Order. Welcome to public accounts on Thursday, the 23rd of January, 2025. The whole of government accounts provides a picture of the nation's public finances. It combines the accounts of over 10,000 public bodies. The WGA 22.3 is the 14th WGA to be published since it was first launched. For the first time in its history, the Comptroller and Auditor General did not express an opinion on the financial statements of the 22-23 WGA. This disclaimed opinion was due to missing and unaudited data given by severe backlogs in the local authority audits. We are eager to hear today from witnesses what steps they are taking to address these issues in local authority audits, how they're managing large financial liabilities, and the action to improve the usability and timeliness of WGA. So a very warm welcome to everybody. I'll introduce our witnesses. Ahead of me is James Bowler, CBE, the Permanent Secretary of Her Majesty's Treasurer, who was appointed Permanent Secretary in October 22. James, you're very welcome here, and thank you for spending time with us. Conrad Smewing is Director of Public Spending, HMT, and he's been the Delegated Accountant Officer of WGA. To his or my right is Andrew Cartner, Director of Public Spending, HMT, and Deputy Head of Government Finance Function. Andrew, can I just thank you and your team very much? We had a briefing on this last week, and your team were very, very helpful. So thank you for attending that briefing. Will Garton, on James's on my left. Will is the Director General for Local Growth and Communities and Devolution in the Ministry of Housing and Communities and Local Government. I think we'll be calling on you, so you're very welcome to be here. And Rosie Seymour, finally, but by no means least, she is the Director General for Local Government Audit and Ministry of Housing, Communities and Local Government. So I think we'll be calling on you as well. Yes, Rose, it's your first time, so I always like to try and give a special welcome to those that are here for the first time. We are really friendly, quite friendly, really. And I should also like publicly to extend a warm welcome to those behind us who are guests from the Netherlands Supreme Audit Institutions. We are pleased to have their President, Peter Dijs en Berg, and board members with us today. You're all very welcome behind us there. So without any further ado, I'm going to call on Rachel Gilmore to ask the first question, please.
Good morning. This is a question to Andrew Cartner. Given the circumstances we're in, what actions are you taking to improve the quality of reporting within the WGA?
Yeah, no problem. So obviously, as the Chair has said, this version of WGA is the first in history to receive a disclaimed opinion. That is very disappointing, but it's not surprising. We've talked about that in previous committees, and what we've seen is a trend in missing data increasing over the years. In this WGA, we have 211 entities that have missing data. We also have 227 entities that have draft data included, mainly within the local government because of the audit issues. So obviously, a couple of points there. So on the missing data, because we don't have that, we can't include that in the actual accounts in WGA, in the back of the product. So to improve the usage and reported of that, we have a large section in the performance report trying to bring to light what impact that missing data is having on the accounts. So page 18 onwards in the WGA sets that out clearly. And what we can see is the impact of that missing data in the accounts at a high level is that net liabilities in the public sector are overstated by 31.7 billion, and net income is overstated by 34.4 billion. So we set that out there quite clearly in the WGA, and then drilling down a little bit further, if we look at page 27 in the WGA, we can see some of the key categories that are missing. So, for example, just not to go through more, but some really high-level ones on assets, property, plant and equipment. Missing data is estimated at 133 billion. Investment properties at 11 billion, and then we've also on the liability side the public sector pension liability around about 105 billion. So we're very clearly trying to set out the effect of this missing data in the WGA, so users and of that document can clearly see that. The other aspect is draft data. So draft data still has value for us in WGA. It has been prepared under IFRS accounting standards, and we do consolidate that into the accounts. What we are really doing a programme of work to encourage local authorities while all this sort of audit issues are going on to still submit their draft data, because, as I say, that does have some use there. So it's very much on the sort of missing and draft data to really, in the performance report, showcase the impact of doing that. There is also a broader piece of work across the financial accounting system in the public sector to address the local government issues. The first part of that is the backstop plan to...
Andrew, can I just stop you there, because we're going to get into this in some
no
detail
problem.
in a minute.
Yeah.
I think, Rachel, are you finished for the...
I was looking for improvement rather than a dissection of what's missing and what isn't missing. The question was about improvement.
Okay, so I can answer that. So in terms of the missing data section that I talked about, that is sort of a recent addition in the last few, so we've done that. We've added Spotlight in the performance report, so accounting spotlights on IFRS 16, which is a new implementation in this WGA. We've added a spotlight on the discount rate, because we know that has a large impact on liabilities and provisions. So that is an improvement that we've introduced in this WGA to showcase a bit more on that. We've introduced the year at a glance, so some key figures in findings in WGA across the public sector relating to this financial year. So we've looked to introduce improvements where we can. What I would say is, because we are still recovering the timetable, we have prioritised the timeliness of WGA. So we are prioritising that, and we are prioritising producing the accounts, getting them audited and getting them out of the door. So we are introducing improvements where we can, but our focus has definitely been on timeliness. Once we have recovered, we want to do another phase of a WGA project, which very much focuses on further improvements to the product, accessibility and usability.
Thanks, sir.
Okay.
Thank you, Rachel. Chris Kane, please.
Yeah, thank you. I remember my postgraduate business course at Stirling University, where we did the accountancy module, and I always recall my lecturer saying, I've got you for 10 weeks, I can't teach you how to do accounts, but I can teach you how to ask your accountant questions. And that always sticks with me, because this is an incredibly complicated thing for non-practitioners to try and get their head round, including MPs. And we are tasked with scrutinising as part of our job. How are you making this more accessible to MPs? And that's a question for Andrew.
Yeah, absolutely. So there's the things that I've talked about already in terms of the performance report and trying to sort of make it simpler to understand. As the Chair has said, we had a teach-in last week with Public Accounts Committee to try and talk through WGA, what it is, and try and help the understanding of that. We are happy to offer further sessions on that to any parliamentarians who would like to do that. In the past, we have offered WGA sessions for new MPs as well as part of the new MP induction programme, and obviously we're happy to continue to do that as well. So there's a number of things that we've done there, but I think going back to my earlier answer, it is very much around sort of, once we've recovered the timeline, what are some of the things that we can do to improve the performance report. So one specific thing I would mention, which is something that we're going to do on the next version of WGA, which we're aiming to publish in July, so that will be the 15th version of WGA. We're looking to introduce a 15-year trend analysis. So key assets, key liabilities, income and expenditure, so we can see the trend over the 15 years in the UK public sector, and I think that will help make a lot of the information in here more accessible to MPs and the public.
Andrew, it's always dangerous to ask a question which you haven't consulted on, but here we are. Here's an idea. The accountants used to produce, one of the big accounting firms used to produce a little pocket handbook which I found incredibly helpful to carry around with me, because I could just quickly look up how much is the government spending, how much is it getting in income, what's it spending it on. Literally, how about you considering, and I understand it would need to be audited and everything else, but producing a mini pocket handbook of these whole government accounts, so that when we go into questions or do a debate or whatever, we're not taking this with us, we're taking a little pocket handbook with us.
Yes, we can definitely take that away to consider 100%. I think the final point I'll just make on sort of accessibility and usability is part of that Phase 2 programme I was talking about earlier, sort of more medium and longer term. We do want to think about sort of what are the opportunities to sort of digitalise some of this information. That's maybe more beneficial for wider members of the public. But we're really proud of this document and what's in that. We want to continue to push the use of it. We know a number of other countries, I think including the Netherlands, sort of have a digital content around this, and that's something we want to explore in the future.
That's a really useful thing. James Bowler.
Yeah, just to add that I think traditionally the focus has been in Parliament on supply estimates and spending, which obviously MPs have an important role to deliver. The advent of whole of government accounts and indeed departmental accounts means that MPs, Parliament can look at the balance sheet as what, not just expenditure. So the focus has been so much on expenditure in the past. This opens up the balance sheet, and in particular that means assets, but it also means liabilities, provisions, contingent liabilities, and future fiscal risks. So if I was to sell to anyone what whole of government accounts means and how it can help MPs, it would be to move away from just supply estimates and look at those bigger balance sheet type issues and make it more accessible. Your ideas, a pocket handbook, a digital access to it, I think would be very helpful.
Thank you very much, Chris.
Yeah, and the Chair's just given you feedback, which leads me on to my next question, which is I think all MPs could probably give you feedback. Possibly you might want to write us with this rather than going into in-depth just now, but I think I'd be keen to understand how you are continuing to engage with MPs to get their feedback, because when you speak to accountants tend to speak a very specific language, non-practitioners don't, so that constant engagement to refine how you're teaching and how you're making available is important. So I'd be keen to know what sort of feedback you've received, what sort of initiatives you have used to make it more accessible, and to listen to those that you're trying to teach. So maybe you can comment on that this next one. But given how useful this is, as James said, what are you doing to help government, not just MPs? What are you doing to help government make better use of the accounts? And Andrew for that one, I think again is or James or Conrad.
Why don't I pick that one up, because it's definitely a sort of key part of one of the aspects of my job as Director of General Public Spending, covering all the spending teams in the Treasury that speak to all the departments. The Treasury has kind of run for a number of years a sort of internal balance sheet review using the data that the WGA provides on assets and liabilities, particularly on sort of assets and liabilities that aren't necessarily, sort of front and centre of day-to-day spending control conversations, to work with the departments to think how could we get better value from the way that we're managing these assets and liabilities. Just sort of pick a couple of examples of areas where that sort of way of thinking has been quite influential. One is the student loan portfolio, which is obviously an enormous financial asset portfolio that the government has. In I think 2022, there was quite a big reform of the repayment terms of those student loans, which was driven by the fact that previously we were writing down in WGA about 40% of every loan that we made. There were a series of changes to the repayment terms, the threshold and the repayment length, which were designed to recover more of the value of those loans. We reduced the sort of subsidy implicit in those loans down from about 40 down to about 25%. That way of thinking you would only get to from looking at a sort of set of proper accounts like WGA, rather than thinking about cash in and cash out, because they're very long-term assets. and so the recoveries that you're getting are kind of far in the future. But this way of thinking about the public finances draws you to that thing, and the Treasury and DfE work very closely on what should be done about that. So that's one example. There are others I could give, but the sort of we use this and the kind of ongoing balance sheet review as a way of picking out things which otherwise wouldn't necessarily be front and centre of discussions.
Thank you.
Secretary, can I just come back on the very important thing that you said?
Yes,
this is the balance sheet.
Yes.
And we do, as you say, all of us tend to be concentrating a lot of our time on the expenditure but not the income.
Yes.
Can I suggest that the Treasury also needs to take that maxim into account? Because we had a hearing on carbon capture and storage, for which the Treasury has just granted £22 billion over the next 25 years.
Yeah.
And the witnesses we had before us didn't seem to have thought at all how they might be able to get some income back for the taxpayer on that transaction. So can I suggest that the Treasury also changes its thinking on these matters?
Yeah, and I hope we are. I'm not an expert on the carbon capture point, but there's the advent of the National Wealth Fund and the use more of financial assets in that regard is very much about getting the best out of government assets, and rather than, for example, just giving a grant to a company, why not give a loan, why not take equity? Why doesn't the government invest alongside the private sector to get a return, a market rate return, and get its money out? And then of course, you can the government money that you put in can go a lot further when you're getting it back. So that's very much at the heart of what we're looking at, certainly with the National Wealth Fund, but it's applicable all over the place. I mean, I'll give you another example. When we first built nuclear power stations, we didn't think as much about the costs of decommissioning. The costs of decommissioning are in the whole of government accounts, and that they are vast. And we now have a nuclear decommissioning authority, and now when you're building a new nuclear power station, you have to put the costs of all of the future things in the upfront management and tender for the whole organisation. So that's quite a big change. Whereas we're sort of picking up the tab for the 1960s nuclear build without that. But there are other examples I'm sure we can get to. But your point about the Treasury looking for income opportunities more is very well made.
With a little bit of plug to our report when it comes out next week, I think you might like to look at that, because we will cover that.
On carbon capture,
yes.
Certainly.
Yeah. Rachel Gilman.
Thank you. This is to Mr. Bowler. How will you be using the WGA in future? Because at the moment it contains audited information that may be pertinent to new fiscal rules announced in the autumn budget 2024.
So on fiscal rules, we have a rule to balance the current budget, and we have a net financial debt rule. The net financial debt rule, also known as public sector net financial liabilities, is a wider look at the measure of debt. It includes some illiquid financial assets and loans. For example, a wider look at student loans. It includes liabilities, including pension liabilities. And if you like, it's the stock version of public sector borrowing requirement. This opens up the prospects of a wider look at how you go about just the things we were talking about, the use of financial assets, the use of financial loans. We think that's the right thing to do. We think that wider look at things is more credible than the old measure, which, in Conrad's example, didn't really, just looked at the money going out, but didn't look at the assets you were creating in something like student loans. It comes with a set of guardrails around it, so we don't want to let 1,000 flowers bloom and just say to anyone in government, go and give anyone some money for a loan or grant. So some of the rules are we expect a return as good as the cost of borrowing. we expect the very big financial transactions that come out of this to be done by professional bodies like the National Wealth Fund or the British Business Bank. And there are another set of sort of guardrails around what we're doing. In the whole of government accounts, what we do is we consolidate the whole of government accounts to the fiscal rules of the day. So I think these. So in future, we will consolidate the whole of government accounts to those fiscal rules, so you can see how it all flows. In the might need to rest on Mr. Cartner to explain that in any more detail.
And how confident are you that the WGA is reliable for this purpose, given that the audit opinion is expected to be disclaimed in the future?
So, look, as Andrew said, the disclaimer is expected but disappointing. It's because of the if I'm blunt, parlous state of local government audit, which has built up ever since sort of 2014, but most built up very rapidly in 2019. So there are 200 missing entities in the accounts as we are. So as expected, the NAO disclaimed those. That was expected but disappointing. There is a legislated recovery plan in place and it is on track. We can go into the detail of that. Notably, the first legal backstop for local authorities to provide their accounts was in December, and I think at least 90% of local authorities adhered to that.
When did you notice that? Because you said 2014 to 2019, so that's a 5-year period.
Well, I think the history of local government audit is a complicated one. I think the answer was the number of the Audit Commission was abolished in 2014, and then you had the run-up to COVID, and you saw a lot of local authorities failing to provide audited accounts on time. The reasons for that are many, which we can go into. It's complexity, it's coordination, and it's timeliness, I think. But yeah, we charted a very rapid rise from 2019 to last year, and that number is now falling. So I am hopeful for the future, and I'm hopeful that there is a legislative programme on track, and MHCLG colleagues can also talk to the future of the advent of a local audit office to be one body that's going to bring together and simplify, I think, how local authorities should go about doing their accounts. So the plans are in place. It will take a while to get through this. So if you ask me, I mean, it is entirely up to the NAO what they do with our accounts. I wouldn't be surprised if the next set of accounts are disclaimed. We know already that there's slightly less missing data, but it's still significant. The backstop really starts to hit in. The missing data should really start to reduce in 24, 25, and then I think ourselves and the NAO's hope is that by 25, 26 we'll be in a better place. So just being totally honest, we do expect a period of disclaimed accounts for WGA during this period.
With hindsight, would you say that the abolition of the Audit Commission was unfortunate?
You know, I'm desperately tempted to ask my friends in MHCLG. It was the policy of the government of the day. Certainly by the time we get to 2019, local authorities were struggling to deliver their accounts. There's a whole set of reasons for that. Not just the Audit Commission, the capacity in the system, the complexity of accounts, and the fact that they had multiple bodies, I think, all requiring local authorities to do different things. But I don't think it helped.
Thank you. That's very straightforward.
Can I just, while you're thinking, Rachel, just press you, Permanent Secretary, it's not only the disclaimer that we're concerned about, just to get this whole matter out of the way, it's timeliness as well.
Yeah.
So are you working on both things at once?
So, with huge thanks to my very diligent team, we will now publish 4 whole of government accounts in 2 years, and we've published 3 of them. So by summer next year, we'll have published 4 whole of accounts in 2 years, which is really quite some going. As Andrew said, we have been prioritising timeliness to get back to our pre-COVID position, and that will mean that come this next summer we'll be publishing a whole of government accounts the summer after the year end, the year end of accounts. So we'll be back to more timely data.
Thank you very much.
And it's been quite an effort, so thank you to my colleagues.
It is appreciated. It is a big job, and we understand that, and so we're grateful to you for that. And they were delayed, of course, largely because of COVID. So I should make that clear. It's not anybody's not doing their job. It's because of COVID why they were delayed. Rachel Gilmore, sorry to interrupt you.
That's okay. So we're hoping that you have a vision for the future of the WGA. Would you like to outline what your vision is?
Right. We do. I mean, it's the 15th year of whole of government accounts coming up. It is for a much more sophisticated understanding of it gives of the year in review. It allows people to look at 10,000 accounts all in one place, and the real thing is it allows a much more sophisticated understanding of the government's income and expenditure, but I think key its assets and liabilities as well. The vision, I think, is probably to increase its accessibility, to increase its usefulness, and we've already talked a bit about that, and we can talk about it some more. But there are some very good examples of where we are doing a much better job on the use of the balance sheet, not just income and expenditure.
I would hope, given the disclaiming issues, that reliability is part of your vision.
Sorry, certainly.
The WGA. Good.
Yeah, no. I mean, clearly, having a significant amount of missing data and missing entities is hugely suboptimal. So
hugely suboptimal. That's great.
I'm impressed by that myself, actually. There is I think we can confidently say that with the backstop in place and with plans for a local audit office, reliability should increase.
Thank you very much.
Finished?
Yep.
Can I just, before we get on to the details of local government, which we're longing to do, just ask you one question. Reading these accounts rather late last night, and looking at our long-tail liabilities, things like nuclear and pensions. And indeed, I've even had correspondence from constituents and say, God, isn't it marvellous? The long-tail liability for pensions has gone down hugely. But it hasn't really. It's only due to the discount factor. And to the ordinary reader, whom we're trying to encourage to use these accounts more and more, and this is a question to whoever wants to answer it, I'm just wondering whether we couldn't have a constant column in there which eliminates the discount factor so that we can see whether these liabilities really are going up or really are going down.
Yeah. Do you want me to say that? So, I very much agree with you that sort of changes in the discount rate, which can really dominate particularly the large long-term liabilities like pensions. So I think the increase in the discount rate in this set of accounts has reduced the liability by around £1 trillion. Does that mean that we're going to be paying out less pensions in future? No, it doesn't. It means that the value, the way that we value today those future cash flow streams has reduced. So we do set out very clearly what changes are as a result of the discount rate, what changes are as a result of the underlying changes. But I think we could perhaps do more in the performance report on the future undiscounted liabilities. I would flag, particularly for the very largest ones like pensions, and this is a sort of a theme of how we think about WGA. It's part of an ecosystem of other ways of looking at the public finances. So the OBR's fiscal sustainability report, which has sort of projections for net public sector pensions out over 50 years in an undiscounted way. That will give you an alternative way of looking at it, which is also valid. I do think the change in the discount rate is telling you something. It is it is telling you how much you would effectively pay to get out of the liability today, because the discount rate is higher. You would pay less today to get out of those future liabilities. So I wouldn't want to say that it's like not useful information at all, but I think you're quite right that you want to complement it with...
No, I wasn't in any way saying you should try and get away from it. You can't get away from the discount rate. I mean, it's there, and the liability is for tens, if not hundreds of years in the case of nuclear away, so you need that. But in terms of accessibility, when I'm looking at something quickly, I'm looking at that table, I'm seeing it was 2.4 trillion, it's now 1.4 trillion. Gosh, it's gone down by $1 trillion. Then I read into the accounts further and I realise because it's largely because of the discount factor. I'm just wondering in that table whether you couldn't have a constant column so we could very easily compare one year with another.
We could definitely look at doing that for the performance report. I'm
yeah,
sure.
We'll definitely take that away to have a look at. I mean, one thing that I would add to what Conrad said, and we discussed this in the briefing last week. Obviously, one of the great things about WGA is it puts a spotlight on these large provisions in liabilities and encourages further work across government. So we know that UKGI are due to publish a report in March around our large provisions and liabilities, which gets at some of the questions that you're asking around, okay, so we know about the discount rate, but the underlying cost drivers and assumptions that drive these provisions, what's happening with them, what are we doing about them? So there'll be a lot of good content in that report coming out in March, and then we can look to bring that into the performance report, and we'll certainly take away and look at your request as well.
Very helpful. Chris, okay.
Question to the Permanent Secretary. The disclaimer on the accounts itself puts a question mark over the value of it to the mind of the to non-accountants. So straight away you've got a perception problem. Yeah. With the disclaimer. So I wonder if you could give us your views on what this criticism of it does to the value of the whole government accounts as an important document. And I noticed when you were talking about how you're going to get the disclaimer off, you talked about the lack of the missing data, but you've also got the unaudited data as well. So there's two elements. So the perceived criticism generally, and also I think you've talked about missing data, but can you talk about unaudited data as well?
Yeah. Look, I agree. I agree with you. Having disclaimed accounts is rare and not and poor. I mean, what we do to try and work through that, given we are where we are, is we put in the performance report, we put the data we have. So that might be past data, so that we're trying to make sure you get the best balanced picture, and in the accounts we'll also put some unqualified, some qualified data in, I think. In terms of what we expect, I would expect missing data to reduce and then qualified data to rise. So you go from not having any data to having a larger amount of qualified data. So I expect that to be the pattern we will see. It's hugely better to have qualified data than it is to have missing data, and I think it's just important that we try, as we have in various spotlights in WGA, to explain it to the reader exactly what we do. It's probably very important for me to say that the missing data does not make these whole of government accounts, worthless. It's 1.3% of net liabilities, which is a very large number. But you can still use the whole of government accounts. You can still look at all of the liabilities and the provisions, less so in the local government area, but certainly in central government and what have you. So it's not the case that this is we're sort of treading water for a few years until we can fill that data up and get a thing. But you are right. There has been a long-standing set of qualifications on the whole of government accounts, and we can go through them. Some of them about boundaries, some of them are about different timescales for different accounts. The one that I am watching very, very carefully at the moment is we have a qualification on the fact that we are a shareholder in NatWest. We don't put that into these accounts. We don't put it in the accounts because we don't think that shareholding NatWest represents a sort of particular chunk of what the government is about. But that shareholding is now just between 8 and 9%. So we can see an exit from that, and we would expect the qualification to fall away once we've put NatWest back into the private sector wholly. So we own we own just about 8 to 9% of it as of today.
I bet
Thank you, Permanent Secretary. I was going to ask whether you thought that the current state of public accounts, particularly the local government accounts, was a mess. I think you described it as a parlour state, which is probably a better description of it. Given we're an advanced democracy, do you think it's an embarrassment that our public finances really are distinctly third rate now in how they're being presented?
Well, I don't think it's great that local authorities have struggled to deliver timely, audited accounts. So I don't suggest anything other than that. It's probably worth saying that doesn't mean, and my colleagues from HCLG can say more, that doesn't mean we don't know what's going on in the local authority area. Yeah. There are lots of other ways in which we check, in particular, the financial health of the local authority area. But if you live in a local authority, if you're the local authority yourself, if you're central government overseeing authority and Parliament, you do want to understand, what the entirety of a local authority's balance sheet looks like. I'm not going to pretend we're in any other different position. I think it is worth saying that the legislative backstop that's now in place with the first set of things has been one big step forward. So in December, over 90% of local authorities now caught up on the backlog to 2022-3, and I think there's 5 more steps.
I'll come on just a second to look at some of those particular details. But don't you think it's embarrassing as a country that we haven't got a national set of accounts which has been audited and approved, and you're having to sit there explaining that?
I don't think it's great, no. We're not the only... we're one of the whole of government accounts which pulls together central government and local government is one of the few. We're one of the few countries that do that in the whole world.
Not doing it very well by the looks of things.
Say again, sorry.
Not doing it very well by the looks of things.
But I'm trying to sort of say where we should be embarrassed and where we needn't be embarrassed. So the whole of government accounts of the UK. What our Dutch colleagues think, but is world class in that it pulls together 10,000 accounts into one place in a relatively timely manner. So I'm not embarrassed about that. I think if anything we're world leading in that regard. But certainly I'm not going to pretend in any way, shape or form that having 200 entities that haven't got audited accounts is in anything other than a relatively parlous state.
On to that particular point then, just 2 aspects of it. First of all, the backstop is the saviour to all this. It's started now. Do you accept that the backstop process was started far too late? I mean, the problem's been around and known about, hasn't it, for many, many years?
Is that to me?
Well, whoever thinks they're responsible for it.
Yes, let's bring you in, Scott, because it's sort of right in your area.
I mean, it might have been that the backstop could have been introduced earlier. There were plans to do it in the last Parliament. They were delayed slightly by the general election. But as James has...
Well, that's a bit late, the general election, isn't it? That's many years after you recognised it was a problem.
But I think it is important to recognise. So, in answer to your original question, Mr. Spencer, I think it is a completely unacceptable state of affairs that we have, where the system as a whole can be disclaimed because of the problems in the local authority, etc. We're not hiding from that at all. I think, but we now have got a realistic and pragmatic plan in place to fix it. That starts with a statutory backstop that is starting to have some effect. We'll have a transition period over the next couple of years, and we'll take powers through primary legislation to put in place an organisation that can rectify the situation. I think it's worth noting that that is a different approach under this administration than the last administration, where the locally led regime was what was favoured. So we have got a change of approach since the change of government.
So I'll come on to the change of approach in just a minute. So we've now got the backstop. What happens if local authorities now can't hit the requirements of the backstop? Yeah. What is the fallback? Are there going to be legal powers to insist that audited accounts are produced by certain deadlines?
So As you know, the backstop is a statutory requirement. In the event that a local authority does not meet the statutory requirement, we will first engage. So the Minister will write to the 10% where we haven't had returns. I will answer your question properly. We will first engage, and the Minister will write to the 10% where we haven't had returns in the coming week or two. We will then be transparent and publish that list so it is clear for everyone to see. I want to be a little bit cautious, though, about precisely what our intervention is in the small number of cases where we haven't had returns, because it is not necessarily the case that it is the responsibility of the local authority. The market as a whole is broken, and so we could go in two-footed on a particular local authority and find that they had a very reasonable and plausible set of explanations as to why they were not able to complete the process. However, in a world in 2 or 3 years' time where we have, with the best will in the world, fixed the market and we are operating back in an acceptable state of affairs, and were a local authority then in that scenario where the market was working, were it to fail to publish its accounts in a timely manner, then the department does have intervention powers. The department has been shown that it is prepared to use them, but I don't think it is reasonable to say that we will necessarily intervene in the small number of instances that occur on this part of the backstop, because the reasons for failure are likely to be multifaceted and complex.
Do you mind if I just... Sorry, Clive, but this committee is 16 members of Parliament from all over the country. Only one of them is included in the WGA this year because their accounts are up to time. So that gives you a nice scale of really how bad the problem is. And one of them at least, their accounts go back to 2019-20. So some of these local authorities are really 5 years overdue. We're always very keen on the stick element of all this, but with that particular local authority, and it's in the public domain, would the department consider what help it could give directly, maybe with advice, as to how to help that particular one that's obviously in a very parlous state? They might have had 3 or 4 different CFOs. There might be any number of problems.
Yes, we would absolutely engage, help, assist, provide support in whatever way we can. That is part of our responsibility. I was just trying to answer Mr. Betts' question on the sanction for the 10% that don't hit the deadline, and be clear that we will take sanctions in the future. We're not frightened to intervene, but we would need to be careful in the current set of circumstances, because where responsibility and accountability lies, there is not a straightforward and simple answer to that question given the state of the market.
Sorry.
No, it's okay. I want to follow up now, but I think Rachel Gilmore asked a very particular and proper question about the Audit Commission. Now, it's the word that you can't speak or couldn't speak, but isn't the reality when the Audit Commission was abolished, there wasn't proper thought given to where responsibility lay for audit overall, so it was fragmented into different bodies, and the capability, the capacity of audit at local level was basically removed to a large extent when the district audit went, and private firms haven't had the willingness and capacity to replace that.
I mean, in 2014 there wasn't a problem. It was a significant problem today. That was a policy decision made at the time. The view of this government is that an overhaul is needed, and that's why we're setting up the local audit office. But would we do exactly the same thing now? I don't think so.
Right, it's a very diplomatic answer. So in terms of the local audit office, this is going to pull together the responsibilities from a number of bodies where it's currently fragmented.
Right.
And it's going to increase capacity in local audit. Is it so? How is it going to do that?
Yeah, so we think of the local audit, one of the problems, is exactly as you identify, is there is a multitude of different actors currently with slightly different incentives, different responsibilities, all of whom are acting logically and rationally as per the system that is set up. But the local audit office will, and we're consulting on some of this, but take registration of firms and regulatory systems leadership from the FRC, audit quality reviews from the FRC and the Institute of Chartered Accountants, enforcement from the FRC, the Code of Practice from the NAO, procurement and contract management from the Public Sector Audit Authority, so that is responsibility for developing the market, and we are consulting on, in order to give the Audit Office powers, the SIPFA code to try and make the accounts less complex, so we have fewer barriers to entry, and critically, public sector procurement of audit. So there is a world that has all of those powers under one roof with one chief executive responsible for delivering the system.
A bit like back to Tony Redmond's recommendations.
Indeed, yes.
Yeah.
And this committee's and the Departmental Select Committee and John Kingman and many other commentators in this space, yes.
Right. So in terms of the capacity,
yep.
Are we certain that the private sector is going to be able to deliver it, or are we going to put an element of public sector capacity in there as well? Is that the intention?
We are consulting on public sector capacity as well. I note that it's 50-50 in Scotland, 100% public sector in Wales, 0 in England. Currently, England is the worst performer of those three nations. So, I mean, I don't want to prejudice the consultation, but I would expect some element of public sector capacity.
The National Audit Office has been involved in that. Perhaps I could ask Dareth Gavis if your role in this as well would be helpful.
Well, I mean, obviously the NAO's role is on the code, and as it said, that would move to the new organisation under the proposals that the government set out. I think my view, and obviously I've worked in both the local and the national audit framework, I think the lack of a public sector capacity has been part of the problem and would help de-risk some of the issues you've been talking about. I suppose the key point I would just say, based on my experience, is it's important not to underestimate what a significant undertaking it is to create that capacity, given that it has gone. And so that will not be instant, but certainly the National Audit Office is sort of willing and able to assist with practical advice on what's required to establish that kind of capability. It's a good job.
And I'd just add in terms of capacity, we're also looking at what auditors do and trying to look at where we can reduce that, because clearly part of the issue is not just how many auditors there are, but how much they're required to do as part of undertaking local audit. And that is where we're looking at the complexity of financial reporting, but also the new local audit office interpreting ISA requirements in relation to local audit rather than across corporate and local audit, so that it's appropriate to the sector itself, and the capacity will then be more available than under the current system.
Is this a problem of the requirements on local councils and then local audit is to deliver to international standards, but then you overlay on that particular requirements for the public sector, particular requirements for councils, which are even more complicated on top of that. Is that the issue you're trying to resolve?
Absolutely. So the strategy that we published last month includes a commitment to look at the complexity of financial reporting in relation to local authorities and local bodies, but also with the local audit office taking on responsibility for interpretation of requirements. The sort of audit side of those international standards would also be something that they would look at.
Complexity is a barrier to the market working effectively, and as a result the market is dysfunctional, and if we can simplify, consolidate, streamline, there's a chance of stimulating a private sector market and a public sector market.
Right. Just picking up then on the role of the local audit office, before I come on to the issue of local government finance problems. Local audit office, is that going to have the capacity? I mean, one of the things I think the Audit Commission used to do well, I mean, not about all the value for money necessarily, and things that ministers got upset with at the time, and councils did very often. But it was a place where auditors could go if they had a really challenging situation in a local authority that was of concern to them and they weren't quite sure how to approach it. They could go there, and there was a repository there of understanding, thinking, appreciating what's happening across the piece. Is that something that the local audit office will be expected to do?
Absolutely. We would expect it to be a centre of expertise. It would be taking on a role in relation to training, working with colleagues at the NAO to make sure that we're making the most of that across the public sector, and it would be there also as a body publishing reports and insights on what's going on, what the challenges are, and ways in which others have approached those.
Right. You mentioned that, I think the Permanent Secretary you mentioned, that it's all really, it isn't as bad as it looks, is because we still know what's going on in local authorities and where there may be problems. How do we if we haven't got any accounts?
So the accounts are a really important tool in our armoury, but they are by no means the only tool by which we understand what is going on in the sector. So I would sort of point to 3 ways in which we engage and try and understand this £70 billion sector that's delivering vital services up and down the country. The first is the department has a series of local authority sustainability financial tools. So we are constantly looking at other forms of published data, levels of reserves, Ofsted reports, percentage of spend on statutory services, and the like. The NAO have seen those tools, they've engaged with them. I think they are of a pretty decent standard. So we have complex and intelligent models. The second thing is that despite, if you like, the numbers bit of the audit sector being broken, we still rely and use public interest reports and value for money reports, and they are a useful contributing factor to our overall assessment of the sector. And the third thing, and as I'm conscious this can sound unspecific and a little bit vague, but as a department, we are thoroughly engaged with the sector, and that is where sort of soft intelligence, our staff and teams based throughout the country, conversations, we use to coordinate our view on authorities at risk. And so last year we had a number of authorities come to us for exceptional financial support, and absolutely none of them were a surprise to us. We felt that we knew there were problems in those set of authorities. This year we'll have a number of other authorities come to us for exceptional financial support. Again, we predicted the list, almost precisely 6 months prior to that. So we do have a good and advanced understanding of what is happening in the sector. We'd very much like an audit system that worked as well to complement it, but we're doing okay without it.
What's your prediction for next year for the number of authorities?
I'm going to leave that particular bit of information for ministers to disclose to the House in the usual way, if I may.
But you're certain you know all the authorities that may be coming?
Well, an authority can come to us at any time for exceptional financial support, so there's not a deadline as such. My point was that if we look back about 6-9 months ago, we had a list of authorities who we were concerned about, and that list is like as we thought it would be.
So you don't expect when these accounts are eventually finalised and audited that any more nasties are going to appear?
I think it's in terms of for this point in time, I think we have a really very good understanding of where what you might call regular financial pressures exist through not being able to keep up with service demand and the like. There is sometimes a quirk that comes out of the system. So, for example, this week Barnet has issued a 114 notice. That is because of a technicality, or not technicality, that's probably the wrong phrasing. That was because of a payment they put into a pension scheme, took it out again, which they shouldn't have done. Both transactions were unlawful. They have realised their mistake. They have declared it. They have to issue a 114 as a consequence by law. That is not something we were aware of before the council came in and engaged with us, because it is an accounting error, in effect. But if a different authority, I do feel confident that we know where, if authority is particularly challenged by pressures in adult social care or children's services or SEND, then I think we have a good grip of where those issues are.
In terms of Barnet, then, when did that happen?
Earlier this week.
No, sorry. When was the illegal transaction?
I don't have that info. I can't. I'd have to write to you and tell you the exact timetable. I don't have.
Is it something the auditor would have picked up if the accounts had been audited?
It is. The accounts were audited, is my understanding in the case of Barnet, and the account auditor didn't pick it up.
It wasn't picked up.
I might come back on this matter because it's really serious, the matter that Mr. Betts is sort of driving at. And we saw from our hearing on SEND that, a very large numbers of local authorities are under financial pressure. And when they're under financial pressure, surely it's even more important that we get up-to-date accounts so that their finance officers, their officers, their councillors know way down the track, long before you know, that they are beginning to get into financial problems. Surely it is really important that we get up to date with this matter as soon as possible, because we want to try and avoid as many 151 situations as we possibly can, because when that happens, it almost inevitably ends up being far more expensive for the local population than if it doesn't happen.
I just couldn't agree more.
Could I just
Yes,
say
of course,
something?
Rachel Gilmore.
Absolutely.
So, maybe I'm a bit thick, but you're telling me that the WGA relies upon what you refer to as soft intelligence, because people talk to each other and then they talk back to you. In my definition, that's anecdotal evidence.
Number 10.
No, so let me try and... Mr. Betts' question was, in the absence of properly functioning accounts, how on earth do you know what's going on? And my answer was threefold. One, we've got a series of complex and relatively sophisticated models that look at the sector.
I understood that.
Secondly, that auditors still produce public interest reports and value for money reports.
Yes, I understand that.
The third, which is separate and independent to WGA, is that we do have a programme of what I would call soft engagement, soft intelligence, talking to the sector, talking to local authorities, being immersed in it. And I realise that is, you could describe that as anecdotal if you like. I think it's more sophisticated than that. And that helps us garner intelligence, understand particular problems. It's not our only tool, because we've got public interest reports, VFM, hard data as well. But it is there, and when you're trying to understand the sector, it is a useful way of...
How can you track and audit soft intelligence?
It's not part of the audit regime per se. It is another thing that the department can and does use to understand the sector. So it is independent to audit, and if we didn't have it, I'm pretty sure the committee would say, well, why aren't you engaging with the sector to properly get under the skin? So I'm just saying we do that systematically, and I think we do it moderately well.
So I'm going to call Clyde Betts in a second, but after him I'm going to do our normal convention of having a short 5-minute break. So Clyde Betts, and then we're going to have a short break.
Just to follow up on probably one of the technicalities I alluded to there, and this is the impact of IFRS 16 on the whole of government accounts. Permanent Secretary, are you able to actually work through now to calculate and adjust what the impact is going to be?
I'm going to pass it over to Andrew in a second, but the answer is that central government has moved over to IFRS 16, which is no small feat. Local government's due to do so in 2004-05. Andrew, is that right?
Yeah, that's right. So, just to expand on that answer, one of the accounting spotlights that I talked about earlier in terms of the accessibility question is outlined on pages 45 and 46. Of the WGA in terms of IFRS 16. So this is the first version of WGA where we've brought that change in for central government. So this is all to do with lease accounting and sort of moving more of our long-term lease liabilities onto the balance sheet. The previous rules allowed for a distinction. The IFRS 16 basically ensures that we have more of them captured, and it goes back to the good financial management and use of the balance sheet that we've talked about before. So what we can see in this WGA is an increase in lease liabilities of 24 billion because of the move to IFRS 16, but also we're recognising increased right of use assets that the benefit the government gets from these leases. So they're on the balance sheet, and that's at 29 billion. And consequently, also, we see a reduce in a category of operating leases. So under previous accounting rules, these are where the government would be classed as not having ownership of the asset. So the asset wouldn't show on the balance sheet, but we would continue to pay an amount in a lease. So they have reduced down by around about 22 billion. So we can see the impact of that. At a further level, what you'll also see is a consequence of this accounting change is some of the asset categories will change. So, for example, MOD had a number of sort of properties and land that it leased, which were shown under plant property and equipment. They've moved now into the right of use asset category that I was talking about. So that's the situation for central government. As James says, local government are due to introduce this in 24-25, and we have an accounts qualification on WGA around different accounting practices. The difference in approach between central government and local government on lease liabilities is one of them. So, for NEO to say, but, if that is implemented, then we hope and expect that aspect of the qualification to remove.
Right, so local government's going to have to introduce this as well, this new system. Given the problems in local government, that's not going to be a seamless transfer, is it?
No.
No, I mean, it adds to the size of the challenge, I think.
Right.
They are due to do so next year.
Okay. And is it well understood then that how leasing arrangements are treated or differently treated depends on the nature of the lease? And particularly given that the Treasury's directive in future to departments that capital and revenue should be separate, and identified capital resources shouldn't be used for revenue. Is this leasing a grey area that can possibly be used by departments to get around those rules?
I mean, this is a very clear international reporting standard. It's sort of globally accepted. There's really strict criteria around what you can sort of capture as a long-term lease and a liability and asset on the balance sheet. And of course, in central government, that's audited by National Audit Office for the departments who've already introduced that. For local government, what I would say is their sort of financial reporting framework and accounting framework is set by SIPFA, but in Treasury we work really closely with them, share sort of knowledge and lessons learned from implementing this. The SIPFA sit on our financial reporting advisory board that we have within Treasury, so we do join up and we'll share experience on implementing this.
Just to pick up the point on the control framework, I think actually the move to IFRS 16 improves the position from the previous setup. So under IS 37, is it? There were two types of leases: operating leases and finance leases, and only the finance leases were scoring in the capital budget. The operating leases were just being expensed through the resource budget in future. For IFRS 16, you're not having that distinction. You're picking up the right of use asset in the capital budget for all of the leases. So I think it's removing one of those sort of cliff edges which can produce perverse control incentives.
Can make it different, you're saying?
No.
You're saying that there might be an issue with the National Audit Office.
No. Sorry if that was misleading. No. So local government will implement this in line with the accounting standard. They're just implementing it later than central government. So we introduced it in central government in financial year 22-23. Local government are doing it in financial year 24-25, but the treatment and the approach will be the same.
Can I just follow that up with one other question? I mean, this whole business of improving accounting standards when the sector is in problems is problematic. One of the other areas that causes local government auditors a great deal of problem is valuations. And now we have a different set of valuations for roads, for example. Roads are roads are roads. It doesn't really matter whether they're national roads or local roads. So why on earth we have a different set of accounting standards for national roads and local roads, I can't imagine. Except that the local government system of historic cost is much, much simpler than the current cost less depreciation. So is it sustainable to have two different systems, and what will that in itself, changing local government road valuations, do to the complexity of the accounts and the time that auditors need to do it, and the specialists that they need to involve to value all these assets?
So a couple of points on that. So you're correct. In central government, we value those infrastructure assets on depreciated replacement costs, which is how much would it cost to build a modern equivalent for that asset. So if it's a road or rail network, depreciated over time. As you say, local government do historic costs, which was the cost when the asset was put in place. The reason we use depreciated replacement costs in in central government is we think that's a sort of better measure, higher value measure, is a more accurate capture of the value of the asset on the UK balance sheet. The historic cost approach is simpler, but some of these assets could have been brought in 20, 30 years ago and the value could have changed and that would not capture that. So that's the reason why we do that in a certain way in central government. The discussion is ongoing with local government in SIPFA about if and when they should be moved to a different valuation approach. There's nothing at the moment sort of mandating local government to value their assets the same way central government do. And we have part of a qualification in WGA recognises that difference, but we continue to engage with SIPFA, and if at a point in the future the value of doing this outweighs the cost and the extra administration of doing that, then that could be a future change, but there's nothing at the moment.
Are there any other assets other than roads where this difference applies?
I think there's also sort of water infrastructure in Scotland. There's a difference in there as well. They would be the two main asset categories.
But just on pragmatism, which you're getting to, there's quite a few qualifications where it's not necessarily the case that we will be putting all of our eggs into getting rid of them, because it depends on the value, essentially the value for money of being able to do that. So another example is that people report in different years, academies, further education, other things, and you've basically got to look at the extent to which we can reasonably get those bodies to do things differently, as you do with local authorities and roads. So, when you do a set of accounts, you do it on international financial reporting standards, and you audit it against the whole set of standards. That's the right thing to do. To do anything else would be wrong. But but it will be the case that you will have some qualifications which, arguably now isn't the time to try and blast your way to get rid of all of them, and that's probably the case why quite a few of the qualifications in whole of government accounts have been there for a little while.
It's a very helpful kind of clarification, Permanent Secretary. Those that are following our proceedings, this is dealt with on page 147 of the whole of government accounts, so that might be helpful. So, as I said, we will now take a short break, and it is 11:08. If we could be back sort of by 11:15, 11:15, that would be really, really helpful. So,
new to me.
We are now back at 11:15, so we will resume, and we will resume, please, with Sarah Green.
Thank you, Chair. My question's to James Bowler, and we've spoken this morning already about the state of local authority audit market, which has been described as suboptimal, dysfunctional and parlous. My question is, what actions have you taken to prevent a reoccurrence of the issues that we've seen in that market?
So the answer is that looking backwards to catch up the implementation of the legal backstop, and looking forwards the bringing together of the local audit office. And I think in particular I'd stress, in terms of stopping a reoccurrence, the local audit office being able to get into capacity in the sector and potential public provision of audit capacity, and this issue of complexity and all these various different bodies being brought into one. I think that is the key to stopping a reoccurrence.
And last May to this committee you gave evidence referring to a carrot of 45 million to address the issues around the declining local authority audit fees. How has that improved things? How has that improved audit delivery?
Gosh, my memory will test me here. I think the answer was that it's just a reality that the costs of audit were rising faster than had been otherwise predicted, and to recognise that the Treasury allocated £45 million over 3 years, I think, to MHCLG to give to local authorities to be able to purchase the audit that was required. So I don't think it was a case of massively improving things, but if we hadn't done that, the local authorities, I guess, would have had to find the money from elsewhere, which, given the state of local government finances, wouldn't have been great.
Does that mean that you'll have to do the same again in the near future?
Well, colleagues will have to work it through, but I mean, I guess the answer is the extent to which we look at the capacity in the market generally. We'll want to look at being able to provide audit at a reasonable price. But yeah, I think
as part of the spending review, we will look to try and allocate money going forward for a 3-year settlement, because one of the actions we know is that by increasing fees for the private sector provision, we have a chance of increasing that provision. That is one element of our plan. So we'll want to do that as part of the next spending review. Yes.
Okay. Thank you. Thank you, Chair.
Thank you very much, Sarah. That's very helpful. Chris, do you want to come in?
I suppose what do you think's caused the local audit crisis? I suppose is a question. Maybe Rosie or Will for that one.
I think it's sort of as we've just discussed. I mean, the 2014 Act allocated responsibility to a multitude of different actors. Those actors, I think, are all acting rationally and doing that is asked for them. But the lack of coordination between them is a factor. I also think it is true that it's ironic, isn't it? Because quite often we look at the public sector and we say, you're not achieving value for money, you're not negotiating hard enough, you're not procuring strongly enough. And actually what the public sector has done in this market is it's procured effectively too hard. So fees falling in public sector audit by sort of 20%, by 40% between 2014 and 18, because the public sector is driving a harder bargain, rising in the private sector, and that has led to a market that does not work. We have to get, as I'm sure the committee knows, to get local authority accounts signed off, they need to be signed off by an audit partner, an individual. There's about 100 of those individuals in the country qualified to do so. That is too few. So we've ended up with fragmentation, we've ended up with the public sector driving sort of too hard a bargain to the extent that the market of private sector provision doesn't work. And that is why Tony Redmond, John Kingman, this committee, the Departmental Select Committee have said you need to bring all of these functions together and think about the system holistically, and that's what the Local Audit Office does.
And are you confident that we're going to fix it? Are you confident that we're...
I don't want to overpromise that. This is an ambitious and difficult reform, but we have set out aspirations to have most disqualified opinions to have ended by the end of the financial year 25-26, to have most qualified opinions ended by 26-27, and to have no disclaimed or qualified opinions by the end of the financial year 27-28. So those are objectives that we've set out publicly. They are ambitious. It is hard. It is possible that, you know, we're back here in 2 years' time and we haven't quite made it, but I think it is better to be demanding of ourselves and to sort of ask and put in place tough targets. But it is a huge overhaul, and I don't want to leave the committee in any doubt that it's quite a hard tanker to turn around, but we are absolutely determined to do so. We know how important it is. We can't have a situation where the whole of government accounts are disclaimed because of the local authority sector. So we're going to give it a good go.
And until you fix it, it's just going to be more money is required to help with the audit fees. So you're going to pay.
That's a part. That is a part of it. And as James said, we put in more money, but we want to have the local audit authority introduced in legislation later this year. We hope to have it sort of up and running in a transitionary effect in 2026. We want it fully operational by 27-28. So we should do all of we should try and pull all these levers as sort of simultaneously. And like the department is working particularly closely with the Controller and Auditor General on trying to sort of foreshadow future arrangements for the Local Audit Office before they're set up in legislation, if that makes sense. So we have regular formal forums where we are trying to, without wishing to prejudge Parliament's passing of the legislation, we're trying to look forward to the new institutional relationships and seeing what we can do now to get there more quickly, if that makes sense.
I remember my time in local government in terms of the prudent approach to accountants. It was always politicians tried to be as less prudent as they can, then it was officers, then it was accountants. The accountants are always the ones that are most prudent. So in terms of your financial forecasting as a department for how long you're going to have money in the budget, additional money to help with this, are the accountants and you in agreement as to how many years in the future you're going to have this additional... You've said you're going to fix it in the next couple of years. Are the accountants agreeing with that?
Yes.
So the forecasting of how long you're going to need this additional funding in your forward planning is the same as what you're telling us?
Yeah, I wouldn't want to give you a sort of spurious... I mean, so we have talked about £45 million going in for over a 3-year period at the last spending review. The local government settlement is a £69 billion sector for a settlement. So it would be sort of disingenuous of me to say I've identified £15 million in 28-29 in advance of a spending review and exactly what that's going to buy. The system is more complex and bigger than that. But the key staging posts for us are spending the last £45 million wisely, which I think has happened. I'll be talking to James and Conrad about what we do at the spending review next time around to put some money into it. And then we hope we have a functioning market by the end of 27-28. That's our objective.
Okay, and just one more, if you mind. I think in last year's committee appearance, Permanent Secretary, I think the Chair talked about the difference between hope and surety. I wonder if your opinion is that we are still hopeful that we're going to do this, or if you've got that assurance yourself that you think we're now beyond, we're better than hope, we've actually got a plan that's going to deliver.
So, you know, Parliament's legislated for the backstop, and the first one has happened. It's worth saying 90% of local authorities did, and the first one required them to do quite a lot of historic data to catch up. So that's happened. There's plans to legislate, which I don't think are particularly contentious for the local authority office. So iron cast things are we can very much point to have happened. In terms of that example you give, I mean, I hope I've been, I'll repeat it if you want, realistic about what we expect. We're doing another whole of government accounts, the fourth in 2 years come this summer. We know now that there's enough missing data in that, probably it'll be for the NAO to take a view, probably to mean that the WGA will be disclaimed again. We'll see. Then we expect that missing data and the backstop to kick in, thereafter. But we're probably looking at 25, 26 as a realistic place there. So I hope I'm being open with you that we're not just all, we're not there's no suggestion that this has all gone away and it's all fine.
I think it's the word hope that's that causes the issue. Hope's not.
We're planning on. We're planning on that. We know now, because the WGA takes an awful long time to put together. We know now that there's slightly less, but still significant missing data for our next whole of government accounts.
And on the local authority side, we have an objective, an aspiration, something we want to achieve to get it. Like no disqualified or declaimed accounts by the end of the financial year 27-28. It would be unwise of us to give you a cast iron guarantee. We can't do that. There are factors beyond. It's an ambitious timeline. So we really want to achieve it. We're going to put our shoulder to the wheel in trying to achieve it. But we can't commit to doing it. Because
no, you can't give us a cast iron guarantee. I don't think we would ask for a cast iron guarantee. But I think what we're trying to get is an assurance. And I think it's as much to do, and language is important for insurance and what we're here. But no, I do take the point, you can't give a cast iron guarantee.
Hope springs eternal.
Hope springs eternal.
Anna Dixon.
Thank you very much, Chair, and good morning to the witnesses. Before I get into my area of questioning, I do have a couple of relevant conflicts of interest. I worked as a civil servant at the Department of Health and Social Care until 2015, and as a result, I do have a civil service pension. So you'll be pleased to know that we're moving on from local authorities and some of the reasons for the disclaimer on the WGA to look at just some of the qualifications. So obviously, even if there were no disclaiming of the opinion, there are a couple of qualifications on the account, actually both relating to the Department of Health and Social Care. The first qualification relates to the 1.4 billion of the PPP inventory, and PPP in this case is personal protective equipment as opposed to PPE, an acronym in the WGA which has a different meaning, and a 1.6 billion pound of impairment and write-down, which I assume relates to dud PPE and disposals of 8 billion of consumption of the inventory. The second also relates to Department of Health and Social Care and to the UK Health Security Agency, which seemed that the Auditor General said they was unable to obtain sufficient appropriate evidence. So just really interested what resolutions you're putting in place to deal with these qualifications on the accounts, and perhaps I could ask you, Perm Secretary, to start.
I'll hand it over, if I may, to give you a more detailed thing in a minute. But I think what you're seeing is the account, the whole of government accounts is the amalgamation of 10,000 accounts, and the big ones are the central government accounts, yes. And one of the biggest is the Department of Health and Social Care's accounts, and you're seeing their accounts, you're seeing the implications of their accounts feeding into the whole of government accounts rightly. So those qualifications move. But Andrew, do you want to bring up?
Yeah, I'll give a quick answer to that one. So in the underlying qualification in DHSC's accounts that you're talking about, that's, as Jim said, that's a significant value, so it's material in WGA terms. So before I answer that specific one, we've had a number of these type of qualifications over the years. So DEFRA have previously had one in terms of their their assets and their valuations and their record keeping. MOD have previously had one. We've been able to, through good work with the departments and the finance function over the last several years, those two in DEFRA and MOD have been removed. The DHSC one, as I say, is to do with inventory records. There's a lot of work happening at the moment within DHSC to improve that. It is an improving picture. the government finance function. Conrad's the head of that function. I'm the deputy head. We lean in to support departments in terms of best practice, in terms of departments who've had similar issues, and share that. So that is an improving picture. And again, for CNAG and NEO to determine. But I think in the future that will become not material to WGA, and I would expect to see that disappear over time. There's a number of other qualifications that we've touched on. I don't know if it's helpful to give a quick summary, or if you feel that we've covered them already.
I think it's fine. I mean, as you say, the Department of Health and Social Care is the largest, and indeed this committee is going to be coming back to the most recent Department of Health accounts, I think, subsequent to this. So we will probably have more opportunity to drill into that. But I don't know whether I could just invite the Controller.
Because I can provide, obviously this is the 22-23 whole of government accounts, and therefore the same year for the Department of Health. Since then we've finished the audit for 23-24 for the department, and this committee will be holding a session on that shortly. And the disclaimed opinion on the UK Health Security Agency has been removed, and it's now a qualified opinion, so much improved from the previous position, and the qualifications on the department accounts are much less significant than in previous years. So good progress in 23-24 in addressing that, and that'll be reflected when you see the 23-24 WGA.
Good, that's positive to hear. So another area in the accounts is the treatment of NatWest Group, obviously previously under public ownership and therefore very much on the government accounts. Gradually, obviously, government disposing of its shareholding to the point that certainly the ONS, the Office for National Statistics, are now reclassified it as private sector. So I just wondered if you could say a little about what you think the expected future impact of these changes in NatWest ownership will be, and the resulting sale on future WGA.
So, and Andrew will correct me if I get this wrong. So we had a qualification based on the fact that we never put our ownership of NatWest fully into the accounts because it was always intended to be temporary, and the exciting, by my standards, the exciting situation is that we can now see the light at the end of that tunnel. Our holding of NatWest, the government's holding in NatWest is 8 to 9%. We're selling it off. So the expectation is certainly by the end of the next financial year that we'll have returned NatWest fully to the private sector, and as and when the whole of government accounts catches up, therefore it would no longer feature as an issue for the whole of government accounts. So that qualification should fall.
Yeah. Okay. Thank you. So another sort of challenge with the WGA is the alignment of financial year ends. Obviously, ideally, all the public sector bodies that you scoop up into the WGA would have the same period. Probably one of the most significant misalignments relates to academy trusts and to further education colleges, with FE colleges now having, again, sort of been reclassified and moved into government accounting. So I think we're talking about some 9,000 academy schools and obviously quite a significant FE sector. So I'd just like to know what progress you're making on resolution around those timing issues for both academies and further education colleges. And again, I'll look to whoever's most appropriate of witnesses.
Yeah, let me pick that one up. So on academies, the position is, as you say, there are about 9,000 academies. Their planning year is obviously the academic year, and so their accounting year is also the academic year. And that is what is leading to the lack of coterminous accounting periods. When we look at this, and coming back to the sort of questions of pragmatism and proportionality, we don't think that running 2 full sets of books for all of those 9,000 academies so that we can remove the qualification in WGA is the right approach. What we had tried to do previously was to essentially infer a 31st of March balance sheet for academies using basically using the information we have and some statistical modelling. But unfortunately, that wasn't something that the CNAG would have been able to audit to his satisfaction, so it wouldn't have removed the qualification. So the position we've reached on academies is that we publish, or rather the Department for Education publish a sort of sector annual report and accounts for academies on the academic year, which started some time ago. WGA uses that, and then we provide a sort of analysis of what the kind of maximum variance is likely to be between those figures and the figures that and what the 31st of March figure might have been, and that shows that although it's not that significant in WGA terms. That's the position for academies at the moment.
Okay, so not seeking to move them to align, so they'll stay on their current pattern. But what could you just give a bit more of the ability to be transparent about the methodology? Is that the intention, that there will be a much more transparent and therefore auditable methodology that you would use to try and model the sort of alignment?
What we do, so on page 118 of the WGA, we sort of compare the balance sheet positions from the SARA, the sector accounts in different in between years, and you can infer that the balance sheet at 31st of March would have been in between those two figures, and you can get a sense of the sort of maximum variance from the number that we are using. So I think we're quite transparent about how we approach it. We think that is a sort of reasonable position given the scale of any potential variance within the sort of whole of.
So does that lead effectively to there being sort of a perpetual qualification relating to this, but there's nothing more sort of proportionate, is your term, Conrad, to do?
So it might be possible in future with improvements in the sort of technology of the accounting to look at this again and see if it was sort of proportional to do it. So if it became possible to do it, then we would definitely want to do that. So I don't want to say it's perpetual, but at the moment this is a position we've reached.
Where are we with FE colleges? Are we in a similar position to have a sector accounting and transparent?
So for FE colleges, they were reclassified into the public sector relatively recently, I think in 2022, and we are we're working through a pilot with the Department for Education of how to approach FE colleges. There are not as many FE colleges as there are academies, but the same academic year, financial year problem arises. The pilot is sort of looking to make sure that that we get the data that we need for parliamentary supply and control on a financial year basis, and then we will kind of use our experience from that to work through what it might be possible to do for further education colleges. I wouldn't want to give a sort of a definitive answer. Again, ideally we would want to be consolidating them properly, but we need to work through the pilot to find out how
When's your pilot concluding?
I think it's 26, 27?
Yeah, it's in time for the 26-27 financial year.
Okay, and you'll take a view at that point whether a similar methodology to academies could be implemented. Right, thank you very much.
Just come in here. In declaring my interests, members' registered interests, the Inland Revenue have just required all private small businesses to move to a 31st of March year end. So I've just had to spend a huge amount of money on accountants to produce an 18-month set of accounts. But it is a one-off. Next year it'll be a lot easier. But surely what is sauce for the goose is sauce for the gander. If the private sector are being forced to do it by HMRC, why are you not taking a much tougher line on these academies and further education institutions?
I think the point is the one that you made for the. So I think what you're referring to is basis period reform for corporation tax, and I think that the Inland Revenue is not forcing anyone to hold two sets of accounts, and certainly not in perpetuity. Whereas the position for academies, we would be forcing academies to do two sets of accounts in perpetuity just for the purposes of WGA. So I think on the kind of proportionality point, it falls the other side of the line.
IFRS 10 requires all consolidated accounts to be within 3 months, of the year end of the consolidated accounts. Academies have their year ends in August. That's a lot more than the 3 months. So effectively, until you can remedy that matter, you are bound to have a qualification in these accounts. The whole thrust of this hearing is to try and reduce these disclaimers and qualifications, and this seems to me an area where you could reduce the qualification.
So, I mean, I definitely agree that we are keen to get the qualifications and disclaimers off as much as we can. We do need to be pragmatic about the level of burden that it would put on the academy sector.
HMRC weren't worried about the burden it put on small businesses.
Now you raised this last time, Chair. So I've got an email here from HMRC, and they would assert, and who knows, but the new system does not require 2 sets of accounts, and business can continue to choose the accounting period that is right for them.
The advice that I got. We'll go back to my advice on the seat.
Anyway,
thank you for that clarification. Well, maybe the HMRC might produce me an answer. Anyway, thank you very much.
That might have been selective quoting from my part.
Nevertheless, having done it,
yes,
it is a one-off thing, and I don't see really why these academies and further education colleges shouldn't be strongly encouraged to do the same. Anna.
Am I on with further going to the liabilities?
Absolutely.
Fine. So sorry, I've concentrated all my questions in the second half of this hearing. So yes, moving on to the issues around liabilities. Obviously, the WGA, I think, has about 4.9 trillion of total liabilities. A very significant proportion are pensions. And was sort of interested to see the split between the funded and effectively unfunded pension liabilities that the WGA exposes. Some of the written evidence we've received from the Institute of Chartered Accountants on this makes the point that due to the discount rate, it's very difficult to actually transparently see the shift in pension liabilities due to public sector pensions, for which the majority are unfunded schemes, in the sense that it's today's contributors and taxpayers who are having to pay the money. And suggests that actually if you did do the calculation, there would be an additional 117 billion added in 22-23 for those public sector employees, but that's not very visible on the face of the accounts. So I just wondered if there was anything more you could do to just talk about the real increases in pension liability rather than the apparent reduction in liability due to the change in the discount rate.
And obviously we touched on this a little bit earlier in the hearing. So for the accounts themselves, we're bound by the accounting rules, and the discount rate that we use does have a very significant impact on the provision. As I said earlier, it's reduced it by $1 trillion. The discount rate, I think, is going up again in 23-24. So again, the provision for public sector pensions will reduce as a result of that. And I think we're very happy to look at ways in the performance report that we can sort of split that out even more clearly for users, so that they can see what is going on in the underlying cash flows as well. I mean, I would repeat sort of the 2 points I made before. One, WGA is a very good way of thinking about public sector pensions. It's not the only way, and the OBR's fiscal sustainability report is a very useful alternative lens which looks at those cash flows without discounting them. And secondly, the change in the discount rate is telling you something. It is a change in the way that you should value future cash compared to cash today. So I wouldn't want to say that the information that is a result of the change of discount rate is sort of useless. I totally agree that it needs to be separated out from what's going on in the underlying cash flows.
And to a similar point on pensions, obviously actuarial assumptions can also make a very significant difference, in particular things like assumptions about life expectancy. So in terms of the assumptions that underpin this in the WGA, how they've changed, if at all, and whether they materially affect the assumptions about the liabilities. again, is your method similar to that used by the OBR, or do you have your own WGA method, and how transparent is that for readers?
So what we tend to do for these valuations is get the Government Actuaries Department to do all of the work, both for departmental accounts, the accounts of the pension schemes themselves feeding through into WGA, and they also will be doing all of the underlying modelling for the OBR's analysis. So we've sort of got one centre of deep expertise on public service pensions, and I think it's one set of assumptions underlying all of that. I don't know, Ange, if there's anything you'd add on.
Yeah, I would just add to a couple of points. So this goes back to what we were talking about right at the start of the session around some improvements that we have made to how we present this in the WGA, but we're going to take points away to see what else we can do. If you look at page 73 of WGA, there is a chart which shows how the pension liability has moved over the year, and you can see the big line in there is a revaluation loss, around about 1.3 billion. The majority of that is due to the discount rate. More detail in the notes is on page 241, where we get into some of the detail around the underlying causes. So some of the actuarial changes and assumptions that you talked about. So the report talks about the assumed rate of pension increases, the assumed rate of pay rises has reduced in this financial year's calculation because of those actuarial assumptions. So it is in there, but I think it goes back to the point we talked about earlier. It's like, how can we make it a bit more accessible? So we will take that away.
I was going to ask about this. I mean, you've got little bits on pensions all over the place in these WGA. Your system of producing a note, produce the consolidated accounts with a note. Surely then the note would take you to all the bits about you'd wanted to know about pensions. You'd go to that note and you'd get the whole lot, rather than having to look at different bits of the accounts. So can I ask you whether you could consider a change in the presentation of the way you present that kind of information?
Certainly we will look at that. The back part of the WGA is very much produced in line with IFRS and the accounts in the notes, so we do that in a certain format, but certainly the content that we put in the performance report, bringing that together on summary level in cross-reference, and that we will have a look at how we can improve that.
Yeah.
Sorry.
No, of course, Chair. I suppose I want to go beyond presentation. That important to actually look at what you're doing in terms of managing these underlying issues. So, I mean, let's stick with pensions. What actions are you taking with departments and indeed around some of these very large liabilities in terms of the unfunded pensions schemes?
So with the pensions, obviously there was a very big reform to public service pensions in the 2010s, which moved them from final salary to career average, changed the uprating, made a number of other changes, which reduced the cost of public sector pensions. That kind of large reform is not something that you would want to do repeatedly, because you want a stable and relatively clearly understood pension offer for public sector workers. So the terms of the pension themselves, I think, are relatively stable. The question for management is all around essentially how many people you're employing. The sort of that side of things, and that is something where the system that the Treasury operates charges departments for the contribution to the pension, so that they are exposed to the marginal cost of hiring more people and therefore increasing the net public service pension liability, so that they can properly trade off the full cost of employing someone, not just the salary but also the accrued pension, which I think is that current service cost in that graph. They're charged the full cost of that, and therefore if they can find ways to do the same thing with less people, they are incentivised by getting the full benefit of not employing those people.
Obviously, the direction is hiring more doctors, hiring more nurses, police officers. So built into this are there projections and assumptions about workforce growth that arise from changes in government policy?
There should be some workforce growth projections, and I confess I haven't checked quite how we are producing.
Okay, well perhaps you can follow up in a note on that particular point. Thank you. So the other most significant are the contingent liabilities, if I could come to those briefly, Chair, conscious of time. And sitting under the contingent liabilities are obviously nuclear decommissioning, some £18.5 billion, around 27% of the amount, and then the clinical negligence, which again relates to the NHS, some £33.4 billion, which is getting close to 50% of these, contingent liabilities. So I just wondered if you again could say anything about actions being taken to look at how accurate these are, when they might be crystallised, and indeed what actions can be taken to reduce those future liabilities.
On the nuclear decommissioning liabilities, that's obviously the responsibility of the NDA, they do a number of things to try and make sure that they have the most accurate estimate of those liabilities, and I think there have been changes in the valuation of the liability in this WGA as a result of the NDA reviewing costs at some of their sites and seeing how much and how long they think it will take to do the nuclear cleanup. So they do a lot of work to ensure the sort of accuracy of or to the best of their ability, the accuracy of the liability. And then there's an ongoing discussion between the Treasury, the Department for Energy and Net Zero, and the NDA through spending reviews on how to do this most effectively and efficiently with the sort of cost of the liability as it comes due. On clinical negligence, so obviously this liability arises from negligence in the National Health Service. So there's a very strong, even leaving aside the financial costs, there's a very strong desire and drive in the health service to get that down as far as possible. But obviously, the financial consequences are also an important consideration. The primary way that I think the Department of Health and the NHS approach this, and obviously you should speak to them rather than me, is the kind of patient safety strategies and making sure that you reduce the number of incidents which can lead to this liability. But they also do in NHS resolution look at ways that they can manage it more effectively and perhaps reduce the sort of the burden and what's the word I'm looking for? The legal costs around
costs, yes.
reaching a position. So that's the other area that they look at.
I commend you as the co-chair or officer for the APPG on patient safety, as somebody in Treasury with that understanding. But I think it is perhaps not as high profile an issue with the Department of Health and Social Care and NHS England, that the result of not paying attention to patient safety and having the right culture ultimately is this enormous, not least the damage obviously to individuals, particularly in terms of maternal outcomes. The tragedy is that these are lifetime costs, hence that's a large part of this, is that it's a lot of the cost coming from maternity safety issues. So well done for sort of answering that, but there obviously is a lot more to do. Again, I'm afraid, Chair, there is this discounting issue on these figures, which suggests that the liability has been almost more than cut in half from 2021-22 of 75.2 to 33.4. But obviously, again, that is mainly as a result of the discount rate. And what we need to understand is, are we going in the right or the wrong direction overall on clinical negligence, for example, or on nuclear decommissioning? Although I think that is something that could be managed down over time, whereas at the moment I don't think clinical negligence is. As you say, there's at least some good news in there that the majority of cases are being settled without going to litigation. People don't like a lot of public money going to the lawyers, so making sure more of that money goes to the families that need it. But I don't know if there's anything else either colleagues wish to raise, particularly on contingent liabilities, and whether you want to offer any further actions that you're taking.
Yeah, can I just... Can I
yes, of course. Look, just to say... this is precisely one of the big uses of whole of government accounts, which is to shine a light on these future fiscal risks and then get into what you can do about them. I take your point about the discount rate, and we've rehearsed the issues around why we discount it. Though, I mean, I think it's in the whole of government accounts. So claims are down a little bit, but claims quadrupled on clinical negligence over 17 years prior to that. Like you say, on NHS resolution, 80% of claims are now resolved without court proceedings, and the cost of those of legal fees was north of £500 million. I'm no expert. You'll know a lot better than me, but I think there's a 3-year maternity plan, which is essentially about midwives and getting the workforce in that might reduce something. But I mean, this is exactly where we're keen that the whole of government accounts bites and affects change.
Yes. Well, I hope that through discussions with the Department of Health and Social Care, we will make sure that it does bite in terms of taking patient safety seriously. Thank you.
Is there time to add one further point on that? Just very quickly, just in terms of your question, in terms of the accuracy of the estimation of contingent liabilities in the UKGA, we have UKGI have a centre of expertise in contingent liabilities, working really closely with departments, Nuclear Decommissioning Authority, DHC, in terms of how they estimate these, in terms of the assumptions, in terms of some of the risks that may materialise. So there's a real active programme of work with some experts in how you value these. So that work is ongoing. And as I say, they're due to publish a report in March with a lot more detail around some of these things.
Thank you, Chair.
Thank you, Ms Dixon. Can I, and you were referring to clinical negligence and nuclear decommissioning on page 259 for those that are following it. Can I just come back, Conrad Smewing, on your comments on nuclear decommissioning? Now, this committee has been in recent years to Sellafield twice. We're going again in March. My impression, February, is it? February. My impression a bit was this is a huge business up there in Sellafield, and it's all very difficult, you've got to understand, because it's to do with health and safety. But I didn't get the impression that there was this real pressure to drive these future liabilities down. And I'm wondering what more in Treasury Permanent Secretary, you may want to come in on this, what more can be done to absolutely see how these costs can be driven down to a minimum.
I mean, I definitely think that like the costs of this decommissioning, both the annual cost, the budget of the NDA every year, and the sort of the long-term liability, thinking about if you're doing something today which is going to push up costs in future, is definitely a crucial element of every spending review discussion we've had with DESNet. So I do think that there is a real drive to do that as efficiently in as value for money way as possible. Be very interested, in anything you learn from your visit, any kind of further ideas that you have. I mean, I think it is, as you say, it's a huge amount of money, and it's an ongoing program which is going to last, decades, many decades. So, if there are other ways that we can, do it more efficiently, we would love to.
We'll keep our eyes open.
Yeah.
The only thing
our excellent clerk has just said that our visit's in February, not March. I wouldn't want to mislead anybody. As the person sort of on behalf of Parliament who has to scrutinise more than any other these contingent liabilities, what are you doing to manage all of them, both at two stages really, when you enter into a contingent liability and as the process goes along, to manage them, to make sure that they are kept as low as possible, practical. And I don't think there's an official sign-off. I mean, for the big ones, I would have expected there would be an official sign-off so that everybody knows that that particular liability is extinguished.
Extinct. So for contracting contingent liabilities, there is definitely a control framework. So we've done two big things in this area in recent years. The first one is setting out the contingent liability control framework, which requires approval from the Treasury to take out large contingent liabilities above a threshold, and we have also looked to sort of synchronise decisions on those contingent liabilities with fiscal events, with spring statements and budgets, so that you can take kind of decisions on incurring those kind of fiscal costs in the round with the broader fiscal position. That's the first one. The second one is the creation of the central capability, which Andrew was referring to in UKGI, who do a number of things. Number one, they kind of bring together the reporting on all of this into a much more accessible way and shine a spotlight on these liabilities. Number two, they offer expert support to departments who have one of these things coming up, to think about valuation, to think about charging. What is the if this is a kind of guarantee where it might be appropriate for the government to charge the recipient of the guarantee, what is the right price to do that, and the management of the liabilities themselves once they've been taken out. So that's the sort of the main area of work that we've done on these things.
Thank you for that. Couple more questions for me on presentation and facts in the reports, please, if I may. A lot of things are mentioned in these reports, but some of them don't really have, in my view, a good enough explanation. So I was, for example, just to give you one example, looking to see if I could find out what the liabilities of the European Union were. And I couldn't really get it from the information. So I'm just wondering on certain things, and the next question I'm going to go on is the Bank of England purchase facility. And again, I would have welcomed a little, and I'm going to come to you in a minute, Permanent Secretary, to ask why you've done this, but I would have welcomed a bit more explanation as to what exactly it is. Now, I went onto the internet and I've now know an awful lot about it, but one of the things of making these accounts accessible is not to have to do that. You should be able to get it from the accounts themselves. So I'm wondering whether in future whole of government accounts you could consider that.
We definitely could. We obviously need to strike a balance. Already quite long.
I get that. No, I do get that.
Definitely, areas where this committee, other parliamentarians, other users are interested in. We do try and explain as well as we can, and we should also be kind of linking to, places on the internet where you can get more information. Very happy to look at doing that.
Permanent Secretary, I think you're probably the best person to sorry, this is a slightly fastball, but looking at that paragraph on page 271 on the Bank of England asset purchase facility, I'm just wondering why you crystallised the loss of 45 billion in 1 year in up to April 2024 when interest rates were at a reasonable high level. Why you decided to crystallise that in 1 year rather than spread it over a number of years? It's a big sum of money.
I haven't.
I'm happy if you want to write to
with
me.
The paragraph.
No, I'm happy if you want to write to me.
I think the way. Firstly, on your point, where the information sits. So in the Treasury's accounts, you'll have more information about EU liabilities and the asset purchase facility. So we go into more detail. I'm flipping to my Treasury Select Committee answers now, but
I'm happy if you're right.
I'm very happy to. I mean, the answer is akin to the fact that the asset purchase facility is part of monetary policy, and the decisions are made as part of monetary policy, sort of independent of government. But why don't I set it out for you, because it's
really
complicated.
Really helpful. Colleagues, any more questions?
Yes. If I may come back, sorry, Chair. And I don't know whether this was highlighted when you discussed discount rates earlier, but obviously, as we come to the end of this session, the whole sort of value of this whole of government accounts approach is to give us that sort of big picture of where our net position is. And according to the Institute of Chartered Accountants, if you looked at the accounting loss, excluding those discount rate gains, we're talking about some 200 billion, equivalent to 20% of revenue. Now, obviously, that is a very different presentation than, say, you'd get in the national accounts otherwise. So I just, again, it comes down to this thing of, do we really understand our true position, which is effectively that we are still, as a country, spending, or have been in 21, 22, and the years that we've been looking at here, we're spending an awful lot more than we had coming in. So not sustainable?
Well, so I suppose I'd say two things about that. One is for the ongoing deficit. I think WGA is an interesting source, but probably the best thing to look at is the Office of Budget Responsibility forecasting of the deficit, because the key things that matter are, yes, what is the deficit today, but also what are the prospects for it over the next 3, 4, 5 years, given expected government policy, including changes in policy. And so the sort of the OBR forecast that accompanied the autumn budget last year, I think, is the place that I would first go for that key question that you're asking. What's the sustainability of the position? Are we spending more than we are getting in, and is that sustainable? And obviously, the government took a great deal of action in the budget in the autumn to set the public finances on a much sounder footing to meet fiscal rules forecasting for 2029, 30. And so, I mean, that is the place that I would go first for that kind of thing. WGA can sort of shine a light on the edges of public finance, but that core sustainability question, I think, is best done.
You wouldn't read anything too much into the figure that I just sort of cited. I mean, what perspective does it give in addition to the OBR perspective that you're saying is really the one? And obviously, yes, fiscal rules and are we meeting them is a clear thing that the Chancellor's made very clear is the most important thing.
I think it's picking up the same underlying position. So they're both reflecting the underlying deficit. The WGA figure is a broader figure because it will include things like the increase in the pension liability as a result of accruing a further year of that. So I think that is it adds something to the OBR forecast. But in terms of what the government is doing to set public finances back on a stable footing, I think it's the budget and the budget forecasts that primary go to.
I'm really grateful to Ms Dixon for that question, because there is a really worrying statement here on page 37, and I'm going to quote it. It says, debt sustainability, demographic pressures, adapting to climate change and rising geopolitical tensions are projected to increase pressures on public finances over the next 50 years, and this is the important bit, and put public debt on an unsustainable trajectory. Mm-hmm. And on the basis of policy at the spring budget in March 24, and in the absence of policy action to mitigate the rise in debt. But the OBR said that on current projections, debt would treble in the next 50 years. So I'm just wondering how seriously that is taken, Permanent Secretary, within the Treasury.
Very seriously. So this is the OBR's fiscal sustainability report, and they do a 50-year forecast, and they essentially look at if everything stays the same, and the type of issues it raises is an ageing population, the demands on healthcare given an ageing population, climate damage. I think they did another spotlight on it, and other things, and essentially it projects everything current policies going forward, and what the main takeaway from it is that you're going to have to do some things differently.
What is that something different?
Well, then you get into very long lists of issues. I mean, adult social care, for example, ageing population, preparation, prevention, not just paying for things, and a whole set of things. But certainly, this is pretty much the foundation of most of what we're looking at in the Treasury, other than growth, which would be fiscal sustainability. We are one of many countries with an inheritance of COVID and energy, which means we've got need to get to a more sustainable position now, but we also need to look to the future and look at some of the big cost drivers coming our way and what we're going to do about them.
This is a very big question. I'm absolutely certain this committee and other committees will be coming back to this. But you've been very generous with your time, all of us, today. I think this has been an interesting session. We will be reporting on this in the next few weeks with some recommendations, and it'll be very interesting to see how this session has perhaps changed the presentation of how these important numbers are presented to us. So I'm really grateful to all of you, particularly Permanent Secretary. You're all really busy people. The uncorrected version of our transcript will be up and running on our website in the next few days, and our report in due course. So thank you all very, very much.
Thank you. Thank you.